This is the 10-Minute Contrarian Podcast. This is VP. We are a solutions-based podcast diving into the world of contrarian investing and alternative finance. You can find us hosted on the No Nonsense Forex YouTube channel, NoNonsenseForex.com, and podcast players everywhere. Episode 194 is brought to us by Bybit, a roller coaster week in the crypto markets. Lots of opportunities to make money, but only if you're actively participating in this. I mean, how many opportunities has there been just this year? And how many of those have you passed on? It doesn't have to be that way. You know how to trade, right? You have good charts, right? Well, go out there and make money. Click the top link down below in the show notes that takes you to the Bybit blog, read it, and then click my affiliate link at the very bottom and get yourself into this ecosystem. You have what is shown to be a very safe, largely capitalized broker that gives you a lot of extra perks and benefits along the way. So if you're going to trade and make money, at least get all this stuff added on top. And also make sure you have a broker that withstood the largest theft in recorded history. Because with Bybit, membership has its rewards. It is the 10-Minute Contrarian Podcast, and last week we spoke about the crypto market and what to expect going forward. Now, going forward long term, I don't see any reason not to be extremely bullish. But short to mid-term, we know that the market in crypto usually correlates to the market in TradFi. At least it has so far. There will come a day where that correlation likely breaks, but I don't think we're there yet. But short to medium term, I do lean bearish on the overall American stock market. And a lot of it is because of my charts, which we're about to talk about. But there is just so much uncertainty going on right now with something that we have never dealt with in our lifetime. And that is the very real threat of tariffs worldwide. Now, most Americans believe that these tariffs long term will be beneficial. But every transition, as this administration has even said out loud, is tumultuous and a bit bloody and something we're just going to have to suck up. And if I was in this administration, I would do what I think they're probably going to do and let the market go ahead and fall now so they can hopefully get into the recovery phase by midterms. Because right now the Republicans do have the Senate and the House, but not by much. So they only have X amount of time to do what they need to do. But if one of those things is to give the market a healthy correction, which it is needed for such a long time, then it would certainly make sense to me, sooner as opposed to later. And the charts really do dictate this. Like I said, we'll get to that in a moment. But first, I want to give you something else actionable in terms of at least what I'm doing during this period of uncertainty, because it's tough. You can't really move into your bearish playbook because we're not there yet. You can't really stick with the bullish playbook because there's just not a whole lot of reasons to be bullish right now. So with all this uncertainty, what do? Well, I stack cash. Now, I've been doing this for a while in the background, and every time I end up buying something, I kind of curse myself because I don't really want to buy things, but you have to follow your own rules. If there's opportunity there, you need to take advantage, of course. But especially right now, I'm doing nothing but hoarding cash. And like we talked about in the bond ETF episode, I'm not just going to sit there like most people do and let my cash get eaten away by inflation like an idiot. I'm going to get yield on that cash to mitigate inflation. I don't know if I brought this up on X or in Discord, but I moved a lot of my cash into an ETF called JAAA. This is a CLO. This falls a little more in that CEF category, which is an episode we did here on the podcast. I'm very comfortable here, but that's because I know about these instruments. I know them very well. And I'm getting over a 6% yield on my cash by having it here. Now, you should always know what you own. I've been telling some of my friends who are interested in doing this to maybe look more into U.S. Treasuries in the form of a bond ETF, mainly SGOV. This is going to yield you right about 5%. And regardless of what happens out there in the market, the chances of any of this defaulting with either ETF is extremely, extremely low. Not financial advice. Remember that. But we are fortunate to have very high interest rates right now. And in times like this, I am absolutely going to take advantage of it. I've even brought this up on some of my WhatsApp and Telegram forums that I'm a part of, where you don't always have, let's say, the most seasoned investors. Sometimes they skew a bit younger. And what some people are saying is, bro, why are you going to have something like this that after inflation, which is 3% in the U.S. right now, is only going to give me a 2% return? That's stupid. Just buy Bitcoin. I'm like, okay, first off, I've already bought Bitcoin. This has nothing to do with any of that. This is the free cash you have on hand that does not need to be used to pay bills, rent, expenses, things like that. My investments are over here in another bucket. We're just talking about free cash. Second of all, your math is wrong. Because if you think you're only getting a 2% gain by investing in something that gives you a 5% yield, you are assuming that you're starting at zero. You're not. When it comes to inflation, you and everybody else under the sun, or everybody else under the sun in the United States, is not starting at zero. You're starting at -3. So, yeah, you might get a 2% return overall, but that's actually a 5% return because we're talking about the delta between -3 and +2. It could be -3, but instead it's +2. So this is not a 200 basis point move. This is a 500 basis point move. And that is significant. You're not just gaining 2%. You're actually gaining 5 because you're starting off in the hole. And almost nobody is able to wrap their heads around this concept. But that's their problem, not ours. And I suppose while I'm here, you could also just move your cash into gold if you want it protected. A lot of people in the market are going to be doing this. This is why I continue to be very bullish on gold. Now, you're going to want to move it into something to where you can easily move it in and out. And at the end of the day, all we're doing is protecting our cash. And you can do this in a host of ways. For the short to medium term, I would not recommend something like Bitcoin because it can also go down with the market. And if you put a gun to my head, I would say the market probably is going down. But I want to throw those options out there first before we get into the meat of what we're talking about today. Now, the episode is called Canary in the Coalmine. I don't know if this is an American colloquialism or not, but for those who don't know, when you're mining, especially like coal mines and things like that, you have to deal with pockets of gases that can kill you, and these gases are invisible, so you can't see them. So you need some way to tell, hey, am I in an area where this gas is coming and might kill us and we need to turn back? And so what these miners would do was adopt a pet canary because, canaries' bodies are smaller and they're very susceptible to these gases as well. And what would happen is they would walk around, get deeper and deeper into these mines, and if the canary all of a sudden died, that means you were not far behind and you need to turn back. So canary in the coal mine is what everybody in the investment world is looking for, and it's that leading indicator that lets us know that there's a better than average chance that X is ahead, whether that X is bullish movement or bearish movement. In our case, it's bearish movement. So what I want everybody to do is go to your monthly chart. We have already established this on the podcast. The monthly chart is the great cheat code when it comes to investing. And we are going to look for indices that tend to get ahead, or historically have gotten ahead of the rest of the market by at least 1 month. Now, I can only speak for the charts that I have in front of me and the algorithm that I use. And I'm always very careful to tell you what I'm seeing, just like I was way back in the early days of no-nonsense Forex, because I know there's very smart people out there who could possibly reverse engineer the information I give them and have a decent idea of what my indicators might be or what they look like. So I've always been very careful. I know it's low probability, but I do know there's people out there. So if I'm a little cagey, if I'm a little bit cryptic here, just bear with me and use your own systems. So if you look historically, I don't count 2020 because that was that was really panicky, and I don't see something like that ever happening again. I'm looking to the downturn more so in 2022 And then if I have enough data, go all the way back to 2008, which to me was our last real recession. Now, you have to ask yourself, what if we do have a downturn here in modern day? What is that going to look like? Is it going to be this big panic move down like we had in 2020, like we had in 2008, because of a certain catalyst that kind of came out of nowhere? Or is it going to be more like 2022, to where it was more of a slow, gradual correction? I'm hoping it's more like 2022, so I can then get a signal to go bullish more towards the end of the year or maybe early 2026, and then really start to get into that good stuff that we've been talking about on the podcast for probably the last 20, 30 episodes. Your dividend stocks, your CEFs, things like that. Really start to put that generational portfolio together and have that operating on one side while we have our asymmetrical investments operating on the other side. I'm really looking for a place to deploy all of this cash, but I want to do it at cheap prices, obviously. But you have to go bearish before you go bullish. And one of the indices I have found that gets into bearish territory on my algorithm before the other indices do. So before S&P 500, before the Dow Jones, before NASDAQ, is going to be the Russell 2000. And the ticker symbol for this ETF is going to be IWM. Now, this does make a lot of sense. These are more mid-cap companies. Their beta is typically higher, so their volatility is higher. And they are going to be a bit more sensitive to movements. Not super sensitive, though, which is really good. That's how you got a lot of false signals. This is still a very large liquid index that just happens to move a bit more than your major indices do. And in 2022 and 2028 both, IWM entered bearish territory for me before the other ones did. Now, I know this is a small sample size. A whopping 2 examples is not great. But as is often the case, we just don't have data that goes too much further back than 2008. At least doesn't get us to the dot-com crash of 1999-2000. So we have to use what we have. And the good news is, at least I can say recently, is with my algorithm, and probably yours too, go check. Once we got into the muck in 2022, I didn't get one false signal. As soon as I got a bullish signal, it was nothing but up the entire time. And I have not gotten a bearish signal yet. Now remember, a signal isn't what color the candle is right this moment on the monthly chart. We're a week in to the month of March. And there's been a lot of noise in the markets this past week, but that does not concern us. We lay back. We wait for the candle to complete, and we are much, much better off for it. But I can say that on my charts, IWM is not signaling bearishness yet, but it is getting awfully close. Now, if IWM has not been a great canary in the coal mine for you, then maybe you need something that moves just a little bit quicker than IWM, and that is going to be the iShares Microcap Index, ticker symbol IWC. Great watchmaker, by the way. Stupid expensive, but really nice watches. But obviously, when you're dealing with microcaps, yes, they are going to be more volatile than large caps or mid caps, but is still an index, however, so it doesn't go crazy, which is really, really nice. We want something smoothed out like we have with these ETFs. So this is another index I want you to have up on your charts, because there will be a time to move into our bear market playbook. What is our bear market playbook? Well, I've done 194 episodes on this podcast, and a good chunk of them have been dedicated to what to do when the market turns downward. So go back and take a look if you don't know. We will certainly be talking about them when it's time to, but if you want to get an early jump on things, go back to some of those previous episodes. What I'm telling you, what the vast majority of investors do is just stay in the investments they're in, sit there, and eat these losses. when you absolutely don't have to. And a lot of these people are still making 9, 10, yearly percent return on their money overall, year to year on average. Imagine how it could be if you just didn't sit there and take those senseless losses because you actually know how charts work. Win by not losing. We've seen what this does to the calculus when we apply it to Forex trading. It makes a huge, huge difference, and what we're doing here investing is no different. Now, another definitely a better thing to do in this case would be to get out of your investments that are losing and giving you negatives and simply sit in cash. Bonus points if you have the sense to earn yield on that cash. This is a far better approach, but it's not the most optimal approach. The most optimal, and it takes a bit of risk, but it could very well be worth doing, is to step into your bear market playbook and start investing into things that do well during a down market. So in other words, you can take negatives for no reason, you could be neutral and not take anything, or you could actually get gains on the way up and on the way down. I think personally those last two options are absolutely worth exploring. But I want to give you one more instrument you can use on top of IWM and IWC, and that's quite simply to chart NVIDIA. NVIDIA is probably the same market cap as some of these indices are on their own. And everybody says NVIDIA is pretty much the entire market right now. So if that's the case, why not chart that as well? And when you do, you might see that we just might have a bearish signal forming for the month of March. Maybe in your algorithm, it already formed back in April. For me, it hasn't gotten there yet. But during times like this where you have such a lopsided allocation to not only a group of stocks, but really just to one stock in this particular case, I think history is going to look back on this as hilarious that we allowed this to happen. But since we're already here, I think there's a good chance that NVIDIA could be a great canary in the coal mine for this particular era of time we're in. So the one advice I can give is to put these up on your chart and track them and see when they give you bearish signals, because there is an above average chance they are going to give you a proper signal either way, on the bearish side and on the bullish side when the time comes, before the larger, slower indices do. And if it gives you a false signal and you make the moves that you try to make and you're wrong, so what? Maybe you sold at a certain price, now you got to buy back at a slightly more expensive price. Big deal. The important thing is that you get ahead of the market and you use the tools you have and the skills you have to get the absolute best of it. And we have those skills and we have those tools, and we will eventually get the best of it. Now, I don't know if we're really in a bear market yet, or even if we're heading that way. What I do know is that we are absolutely in a period of uncertainty, and now is the time to put those tools together should we end up going down soon. You are going to know if we are at a point in our history where the odds say that we are going down as soon as possible, and then react accordingly. Because don't forget what we do here, contrarians. We are not crazy. We are just early.